Well, good morning. Hello, everybody. Welcome, ladies and gentlemen. Welcome to this West of England webinar. Today, we're focusing on bills of lading, in particular, delivery of cargo without bills of lading, and also on e-bills. We have three speakers today for this seminar. Firstly, I will be talking about claims by banks where cargo is delivered without a bill of lading, and a claim is brought against the carrier. I'll be talking a little bit about the cases that West of England has experienced and also what to look out for when negotiating a letter of indemnity from charterers. I am a barrister and I left the bar to join the West of England Claims Department more years ago than I now care to remember, and I now head up the West of England Defence Team. Secondly, as you'll see on the screen, my colleague Chris Ward will be speaking. Chris is a qualified solicitor. He was in private practice for 5 years with a leading international firm. Chris handles both P&I and FD&D defence claims and is here in London office with me in the European claims team. Chris will be giving us an introduction to electronic bills of lading and talking through the club's position on cover, and also giving us his own views of certain difficulties that he thinks bill of lading users might encounter in the future. Our third speaker today is Ingolf Kaiser, who you'll also see on the screen. Ingolf is a partner of London law firm MFB, with many years of experience in handling as a maritime lawyer and handling claims for both owners and charterers, and also in non-contentious business. Ingolf has worked on a number of electronic bill of lading platforms, and he's helped create the legal structure for the Wave blockchain technology, the bill of lading platform, and he'll be showing us what that platform looks like in practice, and also how you might can handle cargo claims where the bill of lading has been produced from such a platform. I should say, if you have any questions that arise during our presentations, please do put them in the Q&A function. You'll see at the bottom of your screen. I think we've all got quite accustomed to using this over the last 18 months or so. I will then do my best to keep an eye on the questions being asked and pose them to our speakers at the end of the webinar. Word of warning, I may exercise my chairman's privilege, and if there are any very difficult questions, I'll probably put those to Chris and to Ingolf and avoid them myself. But I will try and keep an eye on them and do my best to raise any questions that you have. So, starting off, I will share my screen. Right. So, by way of introduction, it's well known that there is no P&I cover provided by any of the 13 international group clubs where cargo is carried under a negotiable bill of lading and the carrier, usually the owner, but not always, agrees to and delivers the cargo without production of that bill of lading. For example, this is contained in the West of England's Rules 2 under Section 16, exclusions from cover. And the reason for this exclusion of cover is due to the fact that these claims are excluded under the pooling agreement. And the pooling agreement, all 13 international group clubs are subject to and bound by the pooling agreement. Therefore, there's no scope for any individual club to broaden the cover or to take out this exclusion from cover. That's on the P&I side. On the defence side, where the pooling agreement doesn't apply, we have seen at West some cases brought by banks against our members who have delivered cargo without production of the bill. And in that situation, the club has covered the members' legal costs, not the underlying claim, of course, under the defence cover. And in my talk, I'll run through a couple of the cases that we've seen and the defences that our ship owners and disponent owners, charterers have raised in these cases. I'll talk a little bit also about letters of indemnity that a carrier may be offered in exchange for the risk or to compensate him for the risk of delivering cargo without bills of lading, and point out perhaps some of the do's and don'ts or the things to look out for. So the bank as claimants under a bill of lading. A bank's right to claim arises under, in English law, COGSA, the Carriage of Goods by Sea Act 1992. And there, Section 2 provides that a person who becomes the lawful holder of a bill of lading shall have transferred to and vested in him all rights of suit under the contract of carriage as if he had been party to that contract. And this provision is very important, and it gets around what in English law is called the doctrine of privity of contract, whereby a contract only binds the parties to that contract unless it's validly expressly assigned. So therefore, COGSA enables cargo that's bought and sold under bills of lading to be freely tradable, and also allows the end purchaser of that cargo to sue the carrier, i.e. one of the two original parties to the contract, if he alleges the carrier has been in breach of the contract of carriage, for example, as regards delivery without the bill. And under COGSA, it's also well established that a person that's referred to, the person who becomes the lawful holder, includes a bank. And our members, usually the owners, have been facing some claims by banks in this scenario. Most of these claims, fortunately, have involved only a modest or no legal costs. For example, in one case, the bills of lading were supposed to be couriered to the discharge port, but when the envelope arrived, it had been ripped open, and surprise, surprise, the bills of lading had disappeared. And there, in that case, where the West of England member was the ship owner and the carrier, asked for the club's support and assistance to protect the owner, for example, in steps to report the theft to the local police, and also to go to the local courts to declare that the bills were null and void, and also to assist the owner in negotiating a letter of indemnity from the charterer. For example, also the West of England has been called upon in defence where the main dispute has been resolved. From one case, the bank had been paid under the letter of indemnity chain, but then steps needed to be taken for the original bills to be returned to owners for cancellation before the file could be closed. So that's the sort of modest or assistance side with modest costs. We have had some more sizable claims, including the published case last year of Tenacity Marine in the English High Court. So looking at the bottom of my screen there, you can see an example sale contract. And worth bearing in mind that the buyer may have his own funds to buy the cargo, in which case he will only use the services of the issuing bank for the letter of credit. The letter of credit won't actually involve any credit per se at all. But here, the letter of credit is used almost as a performance guarantee. So it ensures that the buyer's funds will only pass across to the seller or the seller's confirming bank once the documents, the bills of lading, have been issued. And again, if you like, it's payment against documents. And equally, the seller has the guarantee that he won't be delivering the cargo until the funds have been released from the buyer. So in that situation, although there may well be a letter of credit, the bank, the issuing bank for the buyer, won't have any financial or property interest in the cargo at all. He won't be the purchaser. That property interest will remain, and financial interest, with the buyer. And the bank will have no right of suit under COGSA. However, if the buyer is borrowing funds from the issuing bank, then when the bills of lading pass through the banking chain from the confirming bank to the issuing bank will not only hold them physically, but the bank will also have transferred into him a financial interest in the cargo, and he will have a right of suit under COGSA 1992. So therefore, in that example, the issuing bank holding the bill of lading with rights of suit, and his buyer doesn't pay him or doesn't satisfy the terms of credit, the bank will be looking to the carrier in that scenario and claiming against the carrier for delivery of cargo without bills of lading. However, in that scenario, all is not lost for the owner. And there are some arguments. I've pinpointed here 8 arguments, or 7 on liability and 1 on quantum. I've identified from the case law, including the West cases, that the carrier can argue in defence to a bank's claim. So first and fundamentally, who is the correct defendant? So obviously, it's very important for the bank to identify the correct defendant. Who is the carrier? Who do they have a right of suit against under COGSA? And banks here, as you can see from recent case law, for example, Giant Ace last year, don't always get it right. Usually the ship owner will be the carrier and the correct person to sue, but not always. In one case, the vessel owner was not the right person to sue. It was the disponent owner who was named on the front face of the bill of lading as the carrier. Equally, the ship owner will not be the carrier where the vessel has been bareboat or demise chartered. And in one case recently, the Hagalos Gabriel, again a published case in 2020, the issue arose as to whether the court would allow the claimant bank, that was the National Bank of Fujairah, additional time to serve its arbitration notice because owners had not disclosed to the bank that there was a bareboat charter. So therefore, it wasn't the owner, but it was the bareboat charterer that the bank should be suing. Secondly, and thirdly, and these two can quite often overlap. So once the bank has got the correct defendant, was the bank the lawful holder under COGSA 92? Or was it simply holding the bill of lading, for example, as agent for its customer? As I mentioned, if the customer has provided the funds and the bank has no financial interest, the bank is not able to sue under the bill of lading, even if physically it holds the bills of lading. And that is under COGSA 92, as I've mentioned. In another West of England case, it didn't go to court. The cargo seller sent the bills of lading to its bank with instructions stating, "We enclose herewith the documents as sent below on collection basis." And they also said instructions to collecting bank, deliver documents against payment. And they instructed the bank to remit the sale proceeds actually to another bank that the client held to the account of another bank that the customer held. So in this case, the member went to for advice, and the advice received there was that there is no evidence in that scenario that it was intended the bank would take any ownership or security interest in the bills of lading or in the cargo under the collection instruction. And the advice was, I think it more likely than not that the bills were in the custody of the bank as agent of the seller, such that the seller remained in possession of the bills and the bank obtained no rights of suit against the owners. And equally, as is stressed in 1998 in the Aegean Sea, that it is clear that the possession of the bill of lading is a necessary but not sufficient condition for being holder of the bill under COGSA. And as I say, 2 and 3 overlap. So the third argument that I've identified looking at the case law in West of England's cases is, did the party taking, who took delivery of the cargo, take as agent for or with the consent of the bank? So in another West case, the bills of lading were endorsed by the bank, and the bank admitted this, to the order of, and I'll keep it anonymous because it wasn't in court, XXX. And it was XXX who actually took physical delivery of the cargo, but it's to the order of XXX for custom purposes only. So the owner had a copy of the original bill of lading as endorsed to XXX, and the owners delivered to XXX, although no bill of lading had been presented. And the question arose there was, even though delivery wasn't against the production of the bill of lading and the bank still held the bill of lading, was delivery by the owners to XXX actually a breach of the contract of carriage or a conversion of the cargo at all? So similarly to this, a similar thread, number 4, is the banker stopped from claiming against the carrier? So in that scenario I've just mentioned, if the owner is found liable to the bank, even though the owner has done what the bill of lading says in accordance with the endorsements that the bank has agreed to, does the owner nevertheless have a defence of estoppel against the bank, i.e. on the basis that the carrier, the owner, relied on the bank's endorsement of the bill of lading when the carrier gave delivery of the cargo? Now, often under English law, or usually, estoppel is a tool, what I like to call a tool of last resort. And the traditional view is no, even in this scenario, this does not provide, the estoppel does not provide a defence to the owner against a claim by the bank. And this has traditionally been on the basis that even though the carrier is doing what the bill of lading on its face, or a copy of the bill of lading on its face says, nevertheless, the charter party often also provides an LOI given by charterers to owners. And this reflects the fact that owners knew all along that they were delivering at risk. They were at risk of a non-delivery claim because they were delivering without production of the bill of lading. So here, the traditional view is that, therefore, even if you are doing effectively what the copy of the bill of lading or the endorsed bill that the bank holds says, you don't have an estoppel defence because you already knew, owner, carrier, that you would be at risk of a non-delivery claim. And this estoppel argument was firmly a big red no against in a Singapore case in 2019 called the UU. And in Singapore, the Singapore Bills of Lading Act is identical to the UK, the English COGSA. And it was held again by the court against the owner on this estoppel argument, where it was said the defendant owner was unable to point to anything said or done by the bank, which could have induced the defendant to conclude that the bank had consented to delivery of the cargo without bill of lading. So unfortunately, often estoppel doesn't work in favour of the carrier. The fifth argument was the bill spent by the time that the bank took possession of the bill? So under COGSA section 2.2, it says when a person becomes a lawful bill of lading, becomes a lawful holder of a bill of lading, possession of the bill no longer gives a right as against the carrier to possession of the goods, then he doesn't have any right of suit. And in the UU, what happened was that the intermediate purchaser of the cargo, Avanti, had a long-term loan facility with the claimant bank, OCB, Overseas Chinese Banking Corp. When the bank then advised its customer, Avanti, after the cargo had been discharged, that the bank was holding the bills of lading and it requested payment, Avanti requested a new finance agreement from the bank, from Overseas Chinese Bank, and the bank agreed to it. So in that scenario, the defendant carrier argued that by the time the bank had agreed the lending facility, this new lending facility, the cargo had already been discharged, the bill had already been spent. So that would provide, the carrier said, a defence to the bank's claim. However, unfortunately, again, the court held against the carrier and said that even though the cargo had been discharged by the time the new loan facility came into existence, the bill of lading had not been spent because it was delivery not against the bill of lading. So it's a little bit of a circular argument that you could say the owner can't win. Therefore, the fact if you deliver cargo not against the bill of lading, that doesn't constitute the bill of lading being spent, and therefore there was no defence to the carrier in that situation. So as I say, these are 5 of the arguments. We have used some or all of them in West of England cases. They often don't result in a complete defence for the carrier, but they certainly help to reduce, for negotiating purposes, the amount of the claim. Argument 6 we've seen, did the bank's delay in raising the alarm? Could the carrier say that therefore the bank caused the claim or the bank failed to mitigate its claim? And in another case, the West of England was a disponent owner. The non-delivery claim here wasn't made by the bank, it was made by one of the traders in the cargo chain, but the arguments are the same. So here there's a one-trip time charter in December 19 to carry steel coils from Chennai to Port Kelang in Malaysia. The cargo was discharged into a warehouse by agents on the 5th of January 2020. The bill of lading was then received on the 10th of January 2020 by the claimant purchaser, but he didn't seek to take delivery of the cargo or in any way. And the next month, in February, another party basically stole the cargo, took delivery of the cargo from the warehouse by forging a delivery order. And then not until July 2020, so some 6-7 months later, did the claimant then first ask about the whereabouts of the cargo and alleging to be the lawful holder under the bill of lading. And that was the first time the local agent actually realised that anything had gone wrong. And then the claimant, when he discovered that the cargo had been stolen, contacted the party taken delivery. He recovered 850,000, then sought against the carrier, our owner, for the balance purchase price. And in that situation, the advice received was that delay by the claimant, although it was 6 or 7 months, and there was no explicable reason for that delay, would not provide a defence. However, the advice was that whilst didn't provide a defence to the claim, the advice was there may be scope to reduce the damages depending upon whether the true holder of the bill of lading, the claimant, has mitigated his loss by attempting to regain possession of the cargo from the third party. The seventh argument, the last argument on liability, is the bank itself bound by the charter term that owners have agreed to deliver cargo without production of bills of lading? So this is here. So where the charter party includes an obligation as between owners and charterers for owners to deliver cargo without production of bills of lading, assuming there's no fraud or suspicious circumstances. So that's in the charter party. The charter party is incorporated into the bill of lading. The bank holds the bill of lading and the bank is subject to the bill of lading. So is the bank bound or has waived because of this agreement whereby the owner has agreed to discharge and deliver the cargo without bills of lading? Then another way of saying the bank can't acquire greater rights by holding the bill of lading than the original parties to the contract of carriage had. I think this is a respectable argument, but the advice we've received is again fairly negative, based on the fact that at the same time the charter parties I've mentioned often provide expressly that the carrier, the owner, will have a letter of indemnity. So the argument is that even though the owner has agreed to deliver and the bank is subject to that right, to that obligation to deliver, equally the owner knows there's a risk of non-delivery. And that's based, for example, on the 1994 case of Smorovsky. I'm not sure that argument. I think I'm more positive on that argument. I can't see how the letter of indemnity, the indemnity obligations between owners and charterers can affect the bank's right or impinge on the bank's position as holder of the bill of lading, which is subject to the charter terms. But that is the established authority so far. And the last argument's on quantum, just two basic provisions. Obviously, the bank can only claim for that part of the cargo that has been delivered without a bill of lading, and also can only claim for the amount it has lent to its customer. It cannot claim for any increased value of the value of that cargo that was delivered without bills of lading. So we've mentioned discharging into a warehouse, and does this solve the problem? This happened in quite a well-known case last year, the Nicola. This was an application. It wasn't a full hearing on the trial of the merits. It was an application by the bank in that case to renew its freezing order that it had against the carrier, the ship owner, who had sold its case under an MOA. So in that case, again, it was a question of cargo was delivered into a bonded warehouse in April 18 in Egypt, and the bank arranged for daily stock movement reports from the warehouse. And over the course of mid-April to mid-May, fraudulent bills were presented to the warehouse, and all the cargo had been discharged, delivered, had been stolen. However, the bank took no steps whatsoever, despite these daily stock movement reports, to find out what was happening or to stop the cargo being released from the warehouse. The bank then reported the theft only to the police 6 months later, and they only notified the owners, the carriers, who they then sued 9 months later, i.e. 10 months after the cargo had been discharged into the warehouse. In the hearing between the parties, as I say, this was for an extension of the freezing order. It wasn't a full trial. Mr. Justice Baker, Andrew Baker, was very critical of the bank and its legal teams and its inaction. And interestingly, it had some comments about these claims in general that I think are very important and might be used quite usefully by carriers in future cases. So in that case, vis-a-vis the warehouse, he said the effective cause and the only effective cause of loss is not the ship owner's discharge of the cargo otherwise and against the bill of lading, but rather the breakdown in the arrangement ashore by way of the claimant bank becoming the victim of a fraud that had nothing to do with the ship owner. And then he also said there'd be formidable difficulties of causation would confront the prospective claim, since the stock management agreement arrangements were in fact successfully accomplished up to the point only that the bonded warehouse later released the cargo against forged documents. That, as it seems to me, has nothing to do legally or factually with the defendant ship owner. And he went on, probably arbiter even more widely, to say there's been debate whether a ship owner delivering to the party entitled but without production of the bill of lading is not a breach of the bill of lading contract at all, or if it is a breach, he's only liable to the party for nominal damages. So again, some very interesting comments, and I wait to see whether those are brought up usefully for carriers in future. And I would also point out that it's well advised for banks to take steps promptly to look after their cargo and take delivery of the cargo where they purport to be the lawful holder of the bill of lading. And again, a carrier will have a claim against a bank if he delays in taking delivery of the cargo, and the carrier has to pay for its storage or its maintenance. And that's been made clear, for examples in the Spiros C in 2000. So, lastly, just a quick canter through. Often an owner will have agreed in a charter party that he will deliver cargo without bills, and the international group has forms A, B, and C of suggested wording. And I just have a few tips for what to look out for if you are the carrier or the owner negotiating a letter of indemnity in this scenario. First and foremost, have a wide list of beneficiaries. Don't exclude the right to go against third parties, Act 99. In some of West of England cases, the member, the ship owner at the top of the charter party and LOI chain has been able to leapfrog directly down the LOI chain to the bottom provider. And that's particularly useful where the bottom provider is a well-known trading house and the charterers in the middle might be insolvent or have no assets. So incredibly important to have that wide list of beneficiaries. Secondly, also a wide list of what I call triggering events, to make sure, if you can, that the letter of indemnity is triggered not just by delivery, discharge of cargo, but also by delivery, and also whether actions done by an agent, even if it's your own agent, make sure that the letter of indemnity answers in all those scenarios if you can. Again, try and have a long time limit or no time limit. And number 4, bear in mind that even if you don't have a separate LOI document, you may well have the benefit of a letter of indemnity by virtue of your charter party. So look carefully at the charter party to see whether you have one provided there. However, a separate LOI document is usually better, firstly because it won't just bind the charter, the two parties of the charter party, this doctrine of privity of contract. And also, as happened in the Songa Winds, it may be that the charter party indemnity has certain restrictions. In that case, the letter of indemnity was supposed to be valid for only 3 months, but the actual physical letter of indemnity document that's signed doesn't contain those restrictions. It's wider, has wider length, wider number of parties, and more triggering events. And as was made clear, for example, in the Miracle Hope, the court will usually bend over backwards to give effect to the letter of indemnity. In the Miracle Hope, the court was quite scathing of Petrobras at the bottom of the chain and made sure that the Petrobras had to cough up under the letter of indemnity, and held that these separate written LOI documents were self-contained documents, and any limiting terms that had were intended in the charter party or laid out in the charter party didn't apply. And lastly, number 5, try to have the bank countersign the letter of indemnity. I have to say, in all my years at West of England, I have very, very rarely seen that happen. But just in case it's possible, obviously do that. And that's the end of my talk. And I will now shortly be handing over to Chris Ward, who, as I say, will be giving us an introduction to electronic bills of lading, the club's position on cover. So over to you, Chris.
Thanks very much, Nicola. I think you've inspired a tranche of questions. So when you have a chance to look at those. Well, hello and good day. So I'm here to give you an introductory talk to electronic bills of lading. I'm conscious that there will be levels of familiarity. Hopefully I will pick each of you up on the way. I hope there would be a consensus that the world as we know it is not one in which e-bills are prevalent. A tiny percentage of commercial cargoes are carried under electronic bills of lading. I think it's something like 1 or maybe even 2%. With a paper bill, we know where we stand. We are used to the way things work, even though the transmission of paper bills is slow, and the requirement for all of the related trading documents to be manually checked for conformity is costly. There is legal uncertainty surrounding e-bills, whereas the three core functions of a paper bill are established throughout the commercial world. A signed set of paper bills is also, by its nature, easily transferable, unique, and possessible by only one party at a time. Perhaps the invention of paper was years ahead of its time, as these advantages were not easily replicated by technology. Are e-bills less susceptible to fraud? We are told that they are, but new ways of doing things will inevitably give rise to teething problems and the vulnerability of naivety. For all these reasons, commercial parties having the majority tended towards conservatism and a wait and see attitude. However, the activity of recent years suggests that increasing attention is being given to electronic bills of lading. The US has had legislation in place since 2003 providing for the use of e-bills. In 2008, the Rotterdam rules were set down, which allow for the use of electronic bills as an alternative to paper. BIMCO released their electronic bills of lading clause for charter parties in 2014. Then in 2017, the UN Commission on International Trade Law published a model law setting out a legislative framework for the use of e-bills. It is entitled the Model Law on Electronic Transferable Records. The pandemic has, of course, accelerated by years our use of remote technological solutions. In recent years, the cryptocurrency Bitcoin has garnered a lot of our attention. The world-renowned investor Warren Buffett describes it as rat poison squared and says basically don't touch it, it's a mirage. But the underlying technology, known as blockchain or a distributed ledger, may have a more lasting impact on humanity. Several e-bill of lading platform providers are already utilizing this technology. In February of this year, Singapore substantially incorporated the UNCITRAL model law into their native legislation. And in April, the Law Commission of England and Wales released a consultation paper and draft bill concerning transferable electronic trading documents, including bills of lading. The international group of P&I clubs also has a growing list of approved e-bill platform providers. In the absence of piecemeal legislative developments, it seems to me there remains much legal uncertainty. The use of paper bills is supported by centuries-old mercantile usage, deeply entrenched into state legal systems all over the world. Paper bills give rise to rights in rem, exercisable against everybody in the whole world, whereas e-bills do not. Paper bills are capable of being possessed under English law, but electronic bills of lading are not. It is only the paper bill of lading holders' rights, therefore, that are protected from infringement by the property torts, namely conversion and trespass. As matters stand, e-bills have been made to work through what are known as club systems. These are closed party networks in which the parties to the bill of lading and any endorsees all sign up to an e-bill of lading platform provider and agree to a set of bylaws on how the e-bill is to operate. These contractual frameworks generate rights in persona, exercisable directly only against the other contracting parties. The international group, your international group, has officially approved of these 7 platform providers. The year next to each provider is the year that they received such approval. The providers currently using distributed ledger technology are also indicated. Admittedly, it isn't a large data set, but it may be seen that the rate of approvals has been accelerating and that all of the recent approvals concern providers using blockchain systems. Where one of these providers is used, then there is club cover in respect of cargo carriage liabilities, subject of course to the traditional exclusions such as antedated bills or the discharge of the cargo in the absence of the bills. If a non-approved provider is used, then there will be club cover only to the extent that liability would have also arisen if a paper bill had been used. So what does approval denote? What are the relevant criteria? The approved providers must have a scheme whereby the parties agree on the validity of the e-bill, even where it is signed electronically, and the contractual terms of the bill are known and are actionable. The system must enable a draft bill to be rejected or claused. In addition, all the approved platforms are required to have a scheme for the transfer of title to the cargo and of the rights of suit, akin to the Carriage of Goods by Sea Act 1992. This is normally premised on there being a novation of the contract of carriage. Will international conventions for the carriage of goods by sea still apply by reason of the port of loading or place of issue? Will the express incorporation of the Hague-Visby rules have the force of law? In the case of these approved providers, yes, that should be the case, as the bylaws all stipulate that such conventions are to apply to the e-bill as if the e-bill had been a paper bill. The Contract Rights of Third Parties Act 1999, of course, stipulates that it has no application to contracts for the carriage of goods by sea. I wonder, does that mean it has no application to an e-bill? What of the provider's bylaws? Interesting questions, but ones which do not arise in the case of the IG approved providers, as the international group requires that they expressly disapply the 1999 Act. Finally, the system providers must accept liability in the event of system failure, for example, if the system is hacked, and they must have in place insurance cover for some millions of dollars in respect of such failure. Okay, this is my take on the advantages and disadvantages of e-bills then. E-bills are proffered as a solution to the need for letters of indemnity to be given for the discharge of the cargo in the absence of the paper bill, typically where delays in the documentary chain have prevented the bill arriving before the ship. That looks to be correct. The long-standing provider Bolero indicates that use of their system over the course of 6 months results in a 90% reduction in the use of LOIs. Certainly, modern ships are fast, but e-bills are faster. If trading documents are remitted in electronic format, potentially they can be reviewed for conformity to some extent electronically also, which could result in a cost saving, ultimately making goods cheaper. The environment would benefit from the enormous reduced use of paper, but be burdened with the additional electricity consumption resulting from extensive use of distributed ledgers. I've heard it suggested that Bitcoin consumes as much electricity as the country of Argentina. It is hoped that the refinement of the technology and advent of renewable energy sources may help to resolve that issue. And the fraud issue. E-bills offer the advantage of digital signatures being applied to closed party systems. The platforms provide audit trails, allowing users to review the progress of a transaction and oversee when and by whom changes are made. If the system is hacked, then the liability is covered by insurance. For those unfamiliar, distributed ledger technology works on the basis that there is no centralized point of trust. Rather, the ledger is on all the users' systems. A single system may attempt to update the ledger, for example, by endorsing a bill of lading. But every system on the ledger must approve the update before it becomes trusted, at which point a new block is immediately added to the chain, which is the permanent record of the ledger since its inception. This technology had been described as unhackable, although some small cryptocurrency providers have begun to experience what are known as 51% attacks. whereby the hacker provides more than half of the computer processing power for the ledger, potentially at great expense to themselves, thereby becoming able to create a fork in the blockchain and sell the same currency twice. More simplistically, hackers could target shippers or carriers' email accounts, provide modified links and email addresses, email redirection, fake websites, and fake e-bills of lading. Of course, fraud happens every day, including with paper, and it isn't possible to make a system perfectly safe. In the absence of express provision to the contrary, an e-bill may arguably be surrendered remotely anywhere, somewhere other than the discharge port, let's say even in another country. There is also variance across providers as to what constitutes a valid surrender. It seems to me that potential problems may be avoided if the e-bill is surrendered in person, in situ at the discharge port, in as analogous a situation as possible to physically handing over a unique piece of paper. However, in circumstances where there is a disconnect in time and place between the surrender of the bill and delivery of the cargo, risk exposure must then be controlled, for example, by the platform provider giving a security code, such as a QR code, and precautionary vigilance, such as verifying ID. There you go, we lived through it. In conclusion, it's been a long time, but e-bills do seem to be gaining momentum. There is an increased legislative focus and a greater investment of commercial funding. Platform providers are using cutting-edge technology, and your international group is ensuring e-bill carriage under controlled circumstances. Thank you all very much for your attention.
Thank you, Chris. Was it an interesting run through on the club's position and the e-bills problems and some queries that you've posed for future use, hopefully, of more electronic bills of lading. We now have Ingolf Kaiser from, as I say, from MFB, who will be talking in particular about the Wave blockchain platform, as Ingolf has been involved in creating the legal structure behind it. So over to you, Ingolf.
Thank you, Nicola, and good morning, good afternoon, good evening, wherever you may be. I would like to start with a little introduction about what we're going to cover today from my side, which will be a look at the Wave system in practice, and then some issues on electronic bills of lading and how they might change what you do at the moment, how they might change, picking up on Nicola's points about LOIs, the use of LOIs going forward and misdelivery risks, how you might approach cargo claims with where electronic bills of lading are involved, and then some future developments which are on the horizon and may or may not all come to pass, but certainly are being discussed at the moment. But just before we go into that, and I will focus on the practice in a minute, but I'd just like to say a few words about the theory as well. Why does it matter? What's the big deal with an electronic bill of lading? Why can't you just have a PDF scan of a bill of lading and move it around? And obviously with a bill of lading, you are changing throughout the life of the bill of lading the parties to the contract of carriage. And that's what requires something special, because you start with a contract between the carrier and the shipper. You end with a contract between the carrier and the consignee or the receiver. And of course, you may have plenty of people in between, also parties to the contract. And more than that, you're not just changing the parties and the rights and obligations in blocks, but banks, for example, are very keen on the fact that they can take the rights under the bill of lading without taking liabilities. And that's how the English legislation works. The Carriage of Goods by Sea Act 1992, its function is to provide a mechanism for the transfer of rights and liabilities under the contract of carriage. And without it, you have to find something else. Now, the Carriage of Goods by Sea Act 1992 doesn't apply to electronic documents. It only applies to paper documents. So as soon as you scan in your bill of lading, as soon as it becomes a PDF, then COGSA 92 doesn't help with the transfer of rights and liabilities. So you need something else. And that is where the contractual structure comes in, and where closed user terms, contractually agreed terms between all of the parties, the system provider, the carrier, and anybody who wants to use the system come in. And all of the systems in some way or another do provide for an ability to convert to paper, so that if at some stage in the process one of the parties doesn't want to or can't handle the electronic side of it, then you can revert to a paper bill of lading. So Wave is one of the products that's been approved. It was approved by the P&I clubs in late 2019, and it operates on a fully decentralized blockchain. Now, what does that mean? So as Chris said, blockchain is based on not having a central registry. In fact, some of the electronic bill of lading providers have a less than fully decentralized blockchain where they control some of the system. But the idea of a fully decentralized blockchain is that, just as with a paper bill, the bill of lading kind of goes into the wild, and from the time when it's issued until the time when it's surrendered at the end, the carrier and indeed the system provider don't know where it is and don't know who has it. And that obviously replicates the position with a paper bill. There is no central registry, and there's no knowledge of who has it at any time. But what is very important is that only one person at a time can control the original of the document, the version that is then going to be accepted by the carrier as capable of being surrendered at the end of the voyage. And to achieve this kind of one at a time access with blockchain, think of it as a token that can't be copied. And so a token that can't be copied is generated by the system, and then the issuer, so the carrier, has that token, and together with the bill of lading, the token and the bill move together, and whoever has that token with the bill at any time has the rights under the contract of carriage and the right to surrender the document and require delivery. The Wave system very closely follows the Carriage of Goods by Sea Act 1992. The Act is based around concepts of possession and endorsement. In some cases, you transfer the rights under a bill of lading simply by transferring possession of the piece of paper with the paper bill, and in some cases you also have to endorse it, and there are different ways to endorse it, and we will see how that works in a minute. Wave is already in use with quite a few customers, including some large container lines. It's been interesting how electronic bills have developed over the years, because the mass uptake in the container market hasn't happened. But I feel that's just around the corner now and is really starting to take off. And obviously, as a business model for electronic bills, if you have 1 or 2, 3, 4, 5, a handful of bills on a bulk cargo ship, it's a different business model to how it works on a container ship, both in terms of the how you make money from it, but also in terms of the potential cost savings and savings of scale, particularly when the systems can be integrated with those of the carrier. MSC, one of the lines offering it at the moment, and here's a quote from a press release from MSC. MSC has chosen Wave BL because it's the only solution that mirrors the traditional paper-based process that the shipping and cargo transportation industry is used to. So the thinking behind Wave is very much to get it as close as possible to a paper bill. So now I have a walkthrough of how the Wave system works. These slides are not bang up to date, but they hopefully will give you an insight into how it works in practice. So we start with a bill of lading that's being generated by the carrier, and it will be generated as a PDF. And it will look very much like the carrier's existing bill of lading. But there are some important differences. So, for example, any bill of lading on Wave must say on its face that this bill of lading is valid only in electronic form on the Wave bill of lading system. And that is so that you can't just print it out and use it. Anybody who attempts to capture that, whether it's by printing it or a screen copy or anything like that, unless you forge it and change it, it will say on its face that it's not valid. You can convert to paper through a process for doing that, but then you have to surrender the electronic document as part of that. So that's a very important tool against fraud. There are also some other small differences to cater for the fact that conventions won't apply automatically, but to ensure that the carrier has the equivalent protection under the Hague or Hague-Lisbon rules that the P&I Club demands. So how is the bill of lading issued? Here is a look at the Wave application. Wave works in different ways. One of them is where users can download an application onto their individual computers, and another is where users can log on to a web-based service, but that web service doesn't provide for a central registry or a central administration. It's just another way to access the system. And just taking a closer look at this screen. So if the carrier wants to issue the bill of lading from his computer, he identifies the bill of lading PDF document. He selects the shipper from an address book of people who are a party to the contractual structure, who've agreed to the terms of the Wave bylaws, the user terms. And then the system needs to know who is the shipper, and needs to know also for the consignee whether the consignee is made out to the bearer or to the order of a named consignee from the address book, or it simply is made out to that consignee. And then the person to whom it's surrendered, well, that's going to be the carrier, but there might be different carrier entities that are authorized to accept surrender of the bill of lading. And when that's done, you click on issue, and then the bill of lading makes its way to the shipper. And this is a look at an inbox from Wave. And here we have a message from the issuer to the shipper, providing the electronic bill of lading, which has now been issued. And if the shipper opens that envelope in his mailbox, he will see this depiction of the bill of lading. It tells him that he is both the possessor, that he has possession, and that he's the shipper. So what is it in possession? Obviously, it's not a piece of paper, but in the bylaws, in the user terms, it is whoever has the original at the time has the right to control the original. That is the person who has possession. Possession of a piece of paper, after all, is simply having it to the exclusion of anybody else. If you've got it, nobody else has it. And that is how it's defined contractually. And then you can click on that, and then you can see the PDF, a visual representation, if you like, of the bill of lading, and you can do things with it. You can print it, you can, obviously, if you print it, it has no value as such, because it will say that it's only valid on the system, but sometimes people need copies printed out. And you can send possession of it to someone else, and they may or may not acquire rights as a result of that. They may just want to have possession or need to have possession for a period of time, and they can send it back, or you can endorse it. And this is, again, designed to allow you to do everything that you could do with a piece of paper. And from the systems that I've worked on over the years, what's always struck me is that it's very important for the technology to work well with the legal structure. It's very difficult if the people doing the IT and the people doing the legal structure are miles apart and not in touch with each other, because how it works is intricately connected to what the rules say about how, what the effect of any particular transaction on the website is going to be. So let's say then that we have a bill of lading, a negotiable bill of lading, which is made out to a named consignee. So if you want to transfer with a paper bill the rights under such a bill of lading to the consignee, there is no need for an endorsement. You would only transfer possession. And so in this example here, the shipper will then select the recipient, and it's called the importer, and will identify him from the address book. And then over here we have the send button, which is still grayed out, and then he clicks send. And at this stage, the shipper can add other documents too. I mean, there's no point having the bill of lading arrive within seconds if the rest of the documents, which maybe require for a letter of credit, take a week to get there. So the system, as most of these systems I think allow, lets you upload other documents as well. Now those documents could also be documents which have, on the Wave system, which have an original identifier with them, which have some way of identifying them as original, but usually it will just be copy documents as would normally be sent, or scanned documents, even if they say original on them. So here we are uploading some documents from the hard drive of the computer of the shipper to go with his bill of lading. And then once that's been done, he now has an envelope which contains a bill of lading, invoice, and a certificate of origin. And he's ready to send that off to the importer. This screen shows now the envelope is sent. And now if we look, we can see in the shipper sent items, the documents that were contained in the envelope that's been sent to the importer. And that's the end of the process for that type of a bill of lading for the shipper. Now, on the other hand, let's say that a bill of lading is consigned to order. So there's no consignee named, and consignee is simply named as to order. So under English law, that requires an endorsement from the shipper before he sends the document. So you can right click on the document and then you see a list of things you can do with it. One of those is to endorse it. So now the shipper wants to endorse. And as with the paper bill, there are different ways you can endorse. You can add a blank endorsement that with a paper bill would just be signing it. You can endorse it to the order of somebody. So delivered to such and such bank or order, or to the order of such and such bank. And that allows the recipient to then endorse it on, or you can simply endorse it to a named recipient, and at that stage it then becomes closed and no further endorsements are possible. So once you've completed the endorsement, that's added, and once again you can add the other documents to your envelope, and then you send them to the consignee or the next person in the chain. The system maintains a record of signatures and endorsements. It doesn't maintain, Wave doesn't maintain a record of possession. So again, this is like a paper bill. When you see the paper bill at the end, you will see who's endorsed it and when, but usually when, as well as who's endorsed it, but you won't see who's had it at any particular time, so that people can choose, depending on how they endorse it, how much is visible or not visible at the end of the process, in the same way as it would be with a paper bill. So if you blank endorse it, then whoever presents the bill has title to sue, assuming they're doing it lawfully. On the other hand, if you've endorsed it to a certain entity or to their order, then it's that named entity that's currently the holder of the bill, currently entitled under it as well. So that was a quick look at how the Wave system works. And I wanted to move on to a few issues about how, in practice, one might deal with the sort of issues that come up more generally with bills of lading in the context of electronic bills. First of all, just a few words about cargo claims. So if we look at the situation after the bill of lading has been surrendered and you're dealing with an electronic bill and a cargo claim under an electronic bill, it's going to pay to have some advance preparation done to understand how the particular system that the bill was issued under works. But the principles, certainly with Wave, the principles are not really different to what you would be looking for with a paper bill. So you're going to be interested in title to sue under the bill of lading. Has it been presented by somebody who is entitled under the bill? So you'll be looking for the name of the shipper, the consignee, you'll be looking for endorsements and the identity of whoever has surrendered the bill. And although the terminology varies slightly, and I think this is similar with the other products as well, but essentially if you're handling the cargo claim, interested in who's presented this and how have they become entitled. So you'll want some understanding of the rules of the system to make sure that this is the correct person and they have been properly entitled under the document. Secondly, the description of the goods. With every cargo claim, you're obviously looking at what exactly has the carrier agreed to have received and in what quantity, what condition. And that's going to be very similar to handling a claim for a paper bill. So with the Wave bill of lading, you'll be looking at the visual representation of the bill, the PDF document, because that is where the carrier has recorded the description, and it's up to the carrier how that is identified and whether it's claused, how it's claused. That's nothing to do with Wave. That's entirely matter for the carrier when the bill of lading is issued. And sometimes, of course, you might be looking at the situation before the bill of lading is surrendered. If there's some incident ongoing with the vessel and you're trying to identify who's entitled, and for that is going to depend a lot on the type of system being used. So some types of system, does the system, if it operates a central registry, does that allow, even if technically it's possible, does that allow the system provider to look, or the carrier to look, to see who's currently entitled? With the Wave product, that's not possible because the carrier and the system provider don't know who has it. So you would follow the same sort of course that you would with a paper bill. Perhaps people will be coming to you saying they're entitled, and you'll be asking, well, why or how are you entitled, or if failing that, to start with a shipper and work your way on from there. But the principles are very similar. It just, I think, will help to have an understanding in advance, if you're working a lot with a particular system, what the procedures are under that system, and how the terminology is used, and what happens to the original, how you can get to see a visual representation of the original and the chain of endorsements on it. And then picking up from what Nicola in particular was talking about earlier. So LOIs, of course, are a fact of life, both for well, in many trades. Is this really going to affect the issuance and the requirement for LOIs? Well, yes. I mean, it clearly is. If you use an electronic bill of lading, the documents are transferred almost instantaneously. The document checking time, of course, will be the same if you're working with a letter of credit in between. But again, it'll be much quicker once they've been checked to pass them on and to move on to the next stage. So, the kind of routine delays that you would see will be much reduced. However, there are still, I think, some reasons why LOIs might be needed, and are very interesting to hear Chris say that Bolero, the oldest established electronic bill of lading provider, we're quoting a figure of 90% did not need an LOI, but clearly that means there's still a percentage that does. And as with LOIs for paper bills of lading, it might be something that arises purely innocently, if it's ever innocent to deliver cargo without a paper bill of lading. But there are obviously going to be circumstances where the risks will be very low. So somebody who's paid for the goods or who's tendered compliant documents to a bank for checking, but they haven't yet been accepted, but who has no possession yet. And that should be much reduced because the time delays will be reduced. But there might still be situations where changes are being made to a bill of lading. So as with paper bills, this isn't going to get rid of people asking for a change of destination. This isn't going to get rid of people asking for switch bills. I mean, the headaches that carriers deal with routinely, some will be reduced, but some will remain. And for example, if you have a change of destination being requested halfway through a chain of endorsees on a bill of lading, what are you going to do? If you're going to issue a new bill of lading, well, that can't really have all the endorsements on it that the old one had, because the people who endorse it have got no interest and no reason to re-endorse. So you're going to issue a new bill with different parties, showing as the shipper, what you're going to say about loading dates, and it may well be that the carrier wants an LOI for that. All of that might take some time, and you might find yourself with the goods arriving at the discharge port before that's been resolved. You might also have the need for an LOI in the context of converting to paper. So if you arrive at a point in the chain of endorsements where somebody says, I can't handle, I don't want to handle an electronic bill, then a paper bill will need to be generated. That will then need to be sent to whoever is currently entitled or whoever they nominate to receive it, and that might take some time. So again, waiting for a paper bill might be a reason for a letter of indemnity being needed to discharge without production of the original e-bill, or in that case, the original paper bill. And that, of course, is also potentially a way for the less good reasons. Whilst people talk about hacking into computer systems and the risks of that, which are certainly there, and we'll have to see, so far they haven't, touch wood, presented much of a problem. But a lot of the misdelivery claims that I've seen over the years have not so much been people breaking into someone's office as people who maybe have in theory would at some stage become entitled under the document, but for cash flow or other reasons can't pay for the goods yet. So they make something up, use that to get paid in the hope that it all then works out in the end. And of course, sometimes it doesn't. And those sort of reasons and excuses, I think, will still be used from time to time. And as I say, sometimes there'll be a genuine reason. It may well be that with the much reduced use of LOIs, there will be increased scrutiny every time an LOI is being requested. I've just said a few words about the increased security. I mean, clearly the cyber risks people talk about, and time will tell how serious those are and how serious those are, whether it's blockchain technology or the risk of getting into a central registry system or whatever. And just as if you have a paper bill of lading in your office, there's a fire or somebody breaks in, with blockchain, if your computer's taken, depending on the sort of scale of operation that you have, if you're a small trader, then it's gone. And then you have to approach the carrier and find other solutions to get your goods. And with containerized cargoes, of course, the very last stage in the process is sometimes where things can go wrong. Electronic bills will be very good at making sure that the person who clicks the surrender button to surrender the bill of lading to the carrier is the right person and is entitled to the bills. But of course, that's not going to be the person who arrives in a lorry to collect the container from the port. And so it'll be up to carriers, I think, still to build in the whatever release procedures, having provided a delivery order or whatever the procedure is at the port to achieve that. But overall, I'd say the risks are much lower clearly with electronic bills of things going wrong along the way. Finally, a quick look at the future. So as Chris mentioned, there are some proposals from the Law Commission for new legislation here in England. There is also the model law through UNCITRAL, and some countries have adopted through their own national laws legislation to deal with electronic bills of lading. I have to say I'm one of those that are much less convinced about the need for this. With an electronic bill of lading, your ship can be arrested, and as a claimant, you can arrest a ship for a claim. It's a claim under a contract of carriage. It's a claim in relation to damage to or loss or damage to the goods. And a lot of the things that you can do with the paper bill of lading, you can do with an electronic bill of lading. In fact, the Law Commission's proposals, as I understand it, are not born out of any doubt about the validity of the contractual structure for providing an effective way to transfer rights and liabilities under a contract of carriage. It is more to do with some issues around the edges of that as to whether or how it might affect your rights in tort against ship owners to bring non-contractual claims if your only evidence of title is the possession, in quotes, of the electronic document. But it becomes quite technical quite quickly, but I think I'd say there are two bodies of opinion as to whether it's necessary legally. And what's more, I mean, the argument's been made that, well, this is going to reduce these complicated user terms that people are having to sign up to at the moment. But if you take out the contract of carriage aspects of it, the transfer of rights and liabilities aspects of it, which is what we are achieving when COGSA 92 doesn't apply to electronic documents, there is still a lot else to the user terms. And I can't really see anybody providing an electronic bill of lading platform of any kind, even if it's compliant with some legislation that doesn't require people to sign up to user terms, and probably quite substantial user terms. And from what I've seen, the part of the user terms that deals with the actual transfer of rights and liabilities, by the time that IP and the IT lawyers have had their contribution to the user terms, I mean, the carriage of goods part of it can actually be relatively small. So I'm not sure it's going to affect the need for user terms going forward. And there's also a connection here to the question of technology and what will happen in the future. And already people are talking about what will happen in the future. Now, the goal with Wave was, and seems to have been quite effective, to replicate as closely as possible what you can do with a paper bill to make that transition to e-commerce. And that's what, from what I've seen, has been quite effective in other areas of e-commerce as well, that you try and copy very closely what people are used to, so that people can feel safe and secure that their procedures and their processes don't change. But then once you've done that, people start to say, well, now I can integrate this with my systems in this way, and now I can achieve the following benefits with my customers in that way. And before you know it, people are talking about actually maybe moving a little bit away, not in any way that's less secure or that doesn't give the advantages that they need, but maybe trying to harness some of the future benefits of technology as well. And I think there's a risk that if one gets too prescriptive in legislation about how a system has to work and what it has to achieve, that you might find people preferring the contractual option in any case, to give them the flexibility that they want. Of course, that depends on how the legislation is drafted and many other things, but that's just a thought on that for now. So that is everything from me. Thank you very much indeed. And I've seen a few questions popping up, but I'm sure everybody will be very interested in those.
Thank you very much, Ingolf. Yes, as you've seen, I've been looking at the Q&A. Thank you, everybody. It says 19 questions. Starting, perhaps I should start with a couple on. I'm conscious that we've run over our hour, which is the sort of target time for our seminar. But I think there have been some very interesting questions. If I pick on some perhaps relating to e-bills, since that's what we were talking about most recently. There's one, for example, is where a carrier is requested to issue an e-bill, is he responsible for ensuring there are no contradictory national laws, or is this the liability of the shipper? I'm not sure whether the contradictory national laws, whether that would be vis-a-vis the rights of claim under the bill of lading, or whether the actual transfer of possession or rights of cargo can transfer properly. But I don't know whether, Ingolf, I'm assuming that the terms and conditions of an e-bill platform will provide which law will apply. I don't know what happens where one of the parties is a national of a law which might have contradicting laws. I don't know if that's been addressed.
Yeah, so I would think of the e-bill as evidence of a contract of carriage in the way that a paper bill is evidence of the contract of carriage. So you would have the usual problems as to what law and jurisdiction you've chosen, as to where the claimants choose to bring their claim, as to whether those courts will disregard the jurisdiction clause and apply any mandatory national legislation. This isn't going to stop the Hamburg rules, for example, applying in countries where the Hamburg rules apply. There are some very marginal differences in that the mandatory application, for example, of the Hague-Visby rules might not work in the same way, and the terms deal with that contractually, but the practical problem here, I think, is more Hamburg or something similar overriding, and you can't stop that whether it's paper bill or e-bill.
Okay, yeah, and another question is, do we know the average percentage of shipping companies using e-bills around the world? It's not something that's out there in the public domain as far as I know, but as you've mentioned, one particular container operator who has signed up to Wave, I think, is it?
Yeah, I know there are others. I'm not sure I should be
disclosing too much.
Trotting out a list at the moment, or how much of it's public. But I mean, there's quite a number, and it's big ones. And of course, there are other products. There's trade lens. There's well, we had a list earlier, and people can choose what suits them best. But it's definitely, as Chris said, is really sort of taken off in the last couple of years. I think, and is growing at the moment.